September and October specifically, known for just being disastrous in the market at times. Some of the most extreme market events happen in October. Black Monday. Could it happen again? What would it look like if it happened now? I got that coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So October has a bad rap. I mean, some of the most extreme market events in recent history, and really going out through all of stock market, U.S. stock market history, happened in the fall. And obviously, we got to exclude sort of the COVID recession, the flash in the pan that was. Obviously, that was last spring. But let's think about this. The worst stock market since the Great Depression was in 08, early 09. That was kicked off in September, and huge just waterfall crash happening in October. So obviously, that time period stands out. What about the crash before that? Now, the dot-com bubble technically burst March of 2000. However, it was fall of 2001, 9/11, that obviously pushed things further, very traumatic in the markets as well. And then who can forget 1987? If you lived through it, you'll never forget. But that's Black Monday. And there was even a Black Monday back during the Great Depression. What would it look like today? What did it look like then? Let's get into it. So the first Black Monday was October 28, 1929. Now, this was during the 1929 stock market crash. This didn't create or lead to the Great Depression, but let's just say it was one of the early dominoes. On that day, Black Monday, October 28, 1929, the stock market dropped nearly 13%, 12.82% that day. Now, that followed a drop of 11% on the Thursday before. So during that small, short window, the stock market had nearly a 20% correction there. Now again, that didn't start the Great Depression, but it was one of the early dominoes that led to a crisis of confidence. I'm using my words carefully there because if you look at how euphoric things are in the market today, and yet the systemic risks, I think we're overlooking lots of systemic risk because we have great confidence in the system and confidence in the Fed and confidence that everything is going to be figured out and be taken care of. Well, when that confidence was erased, lots of wealth was erased as well. There was a run on the banks, and that again helped sort of kick off the early stages of the Great Depression. Next Black Monday was in 1987, of course. So October 1987, the Dow Jones dropped 22.61% in a day. And if you say, well, the Dow, that's only 30 stocks, maybe, there were some that were more extreme. No, the S&P 500 dropped over 20% that day as well. Feel free to check out this link for more details on what happened, but the short answer is what led to it was there was some Securities and Exchange Commission, some policies that were being introduced, and even though up until that point, 1987, the stock market was up 40-some% that year. In 1987. I mean, even after Black Monday, the stock market was still positive in 1987, which is unbelievable. So the market was up 40-some% by that time. It was in the midst of a huge bull market that was lasting 5 years. I mean, investing felt pretty good, kind of like it does right now. And yet there were some policy changes that were being introduced, and the couple weeks prior to Black Monday, the stock market dropped nearly 15%. When some of the policies were officially kind of introduced to market, and again, I'm glossing over a bunch of stuff, the 3 days prior to Black Monday, the stock market dropped over 10%, and then we had that huge one-day decline over 22% on the 19th. So could that happen today? I want to get to that, but what would it look like if it happened today? Check out this chart. If you're into horror movies, it is October, so this is kind of scary time as well. If you're into horror movies or like to be scared, check out that chart. Oh my goodness, that would move a 22% decline in the Dow would move things down nearly 10,000 points, guys, in a day. in one day, from around 34,000 where we're at right now when I'm recording. I don't know when you're digesting this, but down to about 24,000. If you say, hey, well, the S&P 500 wouldn't really impact, what would the impact be there? Pushing it down nearly 1,000 points in a day. In one day for the S&P 500. We're used to that, 1,000 points in a day in extreme times or during extreme events for the Dow, but not for the S&P 500. That would push things from around 4,400 at the time I'm recording to around 3,400. That is extreme. Okay, all right. Could that happen today? It could. It could. This video is not to say it's going to happen. I've had a revelation. No, it could though. It could. And the key point to me is crisis of confidence. As you know, the stock market is a leading indicator. It's out there looking forward, projecting about what is on the horizon. And that is all based on confidence that, we're going in the right direction. And so much of that confidence today is based in Fed decisions, policymakers. If we lose that confidence, we could certainly see a big flash in the pan as well, like we saw in these previous Black Mondays and extreme events. Would it be as severe if we had a big sell-off like that? Would there be stop gaps in place? Well, there are some triggered mechanisms and so on, but to me, I think it absolutely could be that severe. Is the market more connected today than it was back in the last Black Monday, 1987? Absolutely. Absolutely. There's more securitization. There's more margin debt. To me, if you start seeing a waterfall of that magnitude, it will trigger, right? I'm pretty sure back in 1987, there weren't electronic stop losses on nearly every account out there. And if that happens, waves of selling pushing the markets down even more. What about derivatives? I'm assuming the derivatives that we have today are more advanced than what was around 1987, certainly what would have been around in 1929, which would have been nothing. Why do I bring up derivatives? Because that's a security of a security. So you have one security go down and it's going to kick off drops in all sorts of other securities just because one went down, okay? And then lastly, we have more access to information and we can more easily make decisions, or take action, I should say. Back in 1987, what did you need to do? Your rotary dial phone, call your broker, hopefully you get through. The line might be busy, and so you can't place that trade immediately. What happens now? You open your app, Robinhood, click sold, right? Or actually that doesn't happen. They'll shut you down. But you would send an email or you'd call or you'd log into Fidelity, a platform that actually works, and you'd be able to sell. And that would push prices down even more. So would it be as extreme if this crisis of confidence happened again? I'm afraid so. So what could you do? I can't promise you that it won't happen again. I do think there's more measures in place to make it less likely, but guys, it's very, very possible, and with how interrelated things are, I don't think we've learned from that in the past, and so I think it could be as severe, if not even more severe. So what do? At all times, make sure you're not taking more risk than you should for your overall financial plan, okay? Make sure at all times you are aware, am I taking more risk than I should? I should be taking just the right amount of risk for your situation. Second, if you're in distribution phase where you're close to retirement or in retirement, you've got to have dry powder. You've got to have a couple of years of cash, of income need in low risk or cash, because you just never know. That's a prudent approach. And then lastly, I would tell you, make sure you've got the right investment strategy. As you know, as a fan of the Wise Money Show, a diversified mix, so not all your eggs are in one basket, but then a momentum strategy as well, so that your strategy isn't all in one basket as well. Could a momentum strategy trigger out before a Black Monday exists? It's possible, okay? Momentum doesn't happen overnight. And so a momentum strategy, no strategy, is going to be able to look around a corner and say, okay, it's Thursday, I predict Monday is going to be really bad. That's not possible. That's not possible, okay? But just like in 1929 and like in 1987, there were tremors leading up to this, okay? And both of those, it was a couple weeks where the market had, some wild fluctuations. You would hope that a momentum strategy would be able to react that quickly. Typically, it's 2 to 3 weeks where a momentum strategy will adapt. But other than a momentum strategy, I don't know where you'd have any hope. You would constantly be looking out over your shoulder for the boogeyman if you're trying to protect against another crash like this. So to me, The best way to do it is to have that diversified strategy between a diversified account and a momentum strategy as well. Work with your CFP on that. Use this as a fire drill. What would happen? What would your financial picture look like? What would your financial plan look like? What would your investments look like if we saw another Black Monday sort of event? Talk to your CFP on that. Make sure you're protected and have the right strategies in place. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.